year-end balance sheet for our manufacturing, service, and retailing operations shows total current assets of $28.6 billion, of which cash and equivalents are $6.8 billion. Meanwhile, total current liabilities are $12.7 billion, implying net working capital of $15.9 billion. It has become increasingly common for companies like Apple and Dell to finance their business via their suppliers, in some cases with negative working capital. Why is it necessary for these Berkshire businesses to have so much working capital, particularly so much cash? More generally, how do you think about efficiently managing the working capital of a business segment so large, sprawling, and decentralized as this one?
Yeah, well, we have excess cash every place at Berkshire. So we don't, at present, it really doesn't make any difference whether we have it at certain subsidiaries or other subsidiaries. So we have excess cash. As I've pointed out in the past, we'll never go below $20 billion of cash, and we'll actually stay comfortably above it. But allowing for the preferred that's going to, of Kraft Heinz, will be, again, over $60 billion of consolidated cash. We don't really worry much about what pocket it's in. It's not making anything anyway at these levels. Now, if rates move higher, we've actually got the mechanics in process to do sweep accounts and that sort of thing. So I would pay no attention to the particular cash that's being held in that category there. The cash in Berkshire Hathaway Energy, the cash in the railroad, we have independent levels that we don't guarantee their debt, and they run with ample cash, and we would not look at sweeping that down to a minimum. But if you talk about 40 or 50 of our miscellaneous subsidiaries, we will go to a sweep account when rates get where it really makes any difference to do it. But right now, when you're getting zero, it doesn't really make much difference where you get zero. So I think the fellow's overanalyzed it a little bit, but I understand why he did it.
Warren, one of his ideas is, why don't we imitate some of these other people and pay our suppliers a lot more slowly so we have more working capital?
Yeah, well, that's a big thing in business now. And last year, Walmart, for example, went to almost all of their suppliers, as I understand, and certainly the companies that we supply. And they basically had a list of half a dozen things that they wanted present suppliers to agree to. And one of those things was more extended terms. And each of our companies made their own decisions, but my guess is they got more extended terms from most of their suppliers, maybe a very high percentage of their suppliers, and they may have gone from, I don't remember the exact request, but whether they went from 30 to 60 days or what it was, but they got a meaningful extension. So you will, in a couple of years or a year, it takes time to implement, you'll see higher payables relative to sales at Walmart than you saw a year or two ago. And they are under a lot of pressure competing with Amazon and others, and that's one of the ways they expressed it. And I've seen it done other places, and it's conceivable that one of our subsidiaries might deem it wise to do it, but I don't think they will. I mean, I think that the pressure for cash at Berkshire is not that high, and I think that the pressure or the desire for great relations with suppliers would probably overcome, in most of our managers' minds, any desire to start extending terms.
Yeah, I think it's hard to do that brutally when you're rich and your supplier isn't, and think that your supplier is going to love you. And so I think there's something to be said for leaning over backward to have a win-win relationship with both suppliers and customers, always.
It's never been pushed at Berkshire, that's for sure. You can argue we got a pretty good thing going in float anyway, so.
Yeah, and we don't need it. Let somebody else set the record on that one.